we're going to go through innovation and security and regulation, but I think first we want to do a bit of education on what are the building blocks of DeFi, and that really comes from double-clicking on what the builders are putting together and putting out there. So we're going to get to there. First, let's introduce ourselves. Start with Rashawn.
I'm Rashawn Colbert. I'm the head of policy at DYDX Trading. So I'm based at Washington, D.C. Spent a long time on Capitol Hill before coming to my role about 18 months ago. And that's me.
Nice.
Jeff. I'm Jeff Blockinger, COO and General Counsel at Quadrata Inc. We are a digital identity company. We mint NFT passports into digital wallets that include information that show whether or not the individual wallet holder is on a sanctions list. We give you a money laundering score using both on-chain and off-chain information, similar to what traditional financial firms use. We provide accredited investor status for our partners who issue security tokens. It's great to be here to talk to you.
Ed?
Hi, everyone. I'm Ed Felton. I'm a co-founder and chief scientist at Off-Chain Labs. I spent many years as an academic, worked in government a couple times. I was the deputy CTO of the United States for the last 2 years of the Obama administration. So I got to see from the other side of the table what that looks like. 6 years ago, co-founded Off-Chain Labs with a couple of my then students, and I've since left academia. So we are the developers of Arbitrum, which is the leading layer 2 solution for Ethereum. That is personified or implemented by the Arbitrum 1 blockchain and by about 50 other chains that use the Arbitrum technology.
Great. Anna?
Hey everybody, I'm Anna, co-founder of Krypton Labs. Our mission is to bring asset management on-chain, and our first order of business in doing that was to develop an exchange mechanism that eliminates the profit opportunities of predatory trading, things like front-running, short-term arbitrage, and the implication of that is that it brings down transaction costs for everybody else. So we think that's an important first step. It solves a problem that doesn't just exist in DeFi, it exists in all of finance. So for example, anyone here who has a brokerage account, which I imagine is all of you, lose money on transaction, bad execution. The last estimate of that is about $34 billion a year in the US alone. And so that's what we're trying to solve.
Well, it's not totally lost. It's gained by our market maker friends.
Yes.
So it is allocated somewhere. So I want to double click on everything and all the intros we just did. Ed, if we can start with you from the context of what is decentralized finance, sort of answering that question with Arbitrum as your tool. Let's dive in there.
Yeah, so Arbitrum is a blockchain, or the Arbitrum 1 is a blockchain that is Ethereum compatible, which means that it can support smart contracts and tokens and all of this activity. So basically, it gives people a way to, at a very fundamental level, what it does is it gives people a way to create a sort of market structure, embody that in code, and then publish it on chain so that it will execute in a way that is transparent and accountable. People can see what the code is. They can know that that code is what's actually running on the chain, and they know that it will execute correctly, right? And that's what opens up this huge space for innovation. Like the internet was originally, except with this extra layer of transparency and accountability, which of course is super important for finance. And so DeFi is basically all of the creative things that people build in this arena for innovation. And so what we develop in Arbitrum is a blockchain that can very efficiently, very fast, and very reliably execute the smart contracts that define these markets.
Got it. And so I want to go to Rashawn now. And in the paradigm of what you're the alternative to in centralized finance, what is DYDX and how does that layer into what is DeFi? And I think comparing it to what's it an alternative to?
Yeah, so DYDX is a decentralized trading protocol, right? Specifically for the trading of crypto derivatives, right? So derivatives, the futures market is enormous. So typically you go through a variety of different centralized entities in order to gain access to these contracts, to these products. Specifically what makes crypto derivatives, a specific kind called a perpetual, special, is that it doesn't have an end date, right? So in the United States, typically, if you want to trade a future, you want to make a guess on the future price of some asset, you get a contract that will end in 28 days. But a perpetual, through a sort of sophisticated balancing margining system, you're able to keep a position open much longer to kind of to balance your trades in the way that fits many people's strategies or plans a bit more flexibly. So specifically how we're DeFi, initially DYDX was a layer 2 protocol above the Ethereum blockchain, right? So all these transactions would happen in the DYDX protocol, and then they'd be propagate down to the Ethereum chain where they were verified and locked and recorded. Now we actually have a standalone blockchain, the DYDX chain, which gives us independent validators all over the world. It's fully decentralized. And so this brings the fee down, this brings the speed down, and just makes a much more exciting proposition for traders.
And to go on that a bit more, I think of like custody and brokerage and the different services that I get when I go to my Wall Street broker. How do you think about those at DYDX? Maybe with custody and brokerage being two examples.
Yeah, one of the critical things, like, so this is DeFi, and like the D is decentralized.
We got that. We were with you.
Yes. So it is decentralized in that you maintain control of your own assets, right? So you interact with a smart contract, which allows you to never have to go through an intermediary like DYDX or like Schwab or whoever it is. You're controlling your own assets, which again helps with that speed, with that price, and also is safer because you don't have to trust other people what they'll do with your assets.
And I think one of the first innovations that DeFi brought was a decentralized execution environment, and this is smart contracts on top of a blockchain, and the concept of self-custody. You're not relying on someone else to safeguard your assets, which is particularly popular when you see exchanges go down and the customer assets are missing. So the next layer of innovation is starting to come around in market structure. And I think maybe, Anna, do you want to talk a bit about how you're approaching market structure innovation with what you're building?
You know, one thing that DeFi does offer us is the ability to test out, you know, new products or new market structures in a pretty iterative and low-cost way. Just to give you an example, the sort of baked-in features of what we're building was estimated by the SEC about 10 years ago to cost something like $3 billion to deploy and then $2 billion a year just to do this type of monitoring. I should probably tell you what it is that we're actually doing. The mechanism under our exchange, it's an evolution of an order book. It operates by executing all transactions as continuous flows over a period of time. That doesn't make sense to anyone. So I usually use an analogy, which is if I were to sell you this box of water, there's, you know, the normal way to do it would be like, Ed, you're going to be my buyer. Welcome. You know, we would establish some kind of price that's $5 and, you know, I'm selling, you're buying, and the transaction executes instantaneously. Now, if I happen to know that the price of water is going to fall in 3 milliseconds to $3, as long as I get in that 3 millisecond window, unfortunately, you have to pay the cost of my information. That's what you were referring to earlier. On Krypton, there is a second way. We've kind of innovated this second way, invented by my co-founder, Michael, who's in the audience here somewhere, which is that you could actually pour the water out from my vessel into yours. And because the water is being poured as a flow, it's associated with a speed, right? You can pour it fast, you can pour it slower. And because it's associated with speed, we have to agree on that as part of our transaction. So this is kind of the innovation. And so if I know that in 3 milliseconds, the price of water will fall to $3, I have to pour extremely quickly, and I have to telegraph that information to the market before I ever start pouring. So Ed, you can then say to me, why do you need to pour this water so quickly? Maybe I'll only pay you $2.50 now. So this kind of, it turns what was formerly a private piece of information held by every participant in the market into a public piece of information that prices can respond to. So that's kind of how we're thinking about bring information first.
Yes. And this is a classic example of what DeFi enables, right? Somebody has a good idea and you can just go and build it.
Yeah.
Right. And then deploy it and then everyone can use it. Yeah. Right. It's that kind of permissionless innovation that comes in that really is what's powerful here.
And in my practice, the deploy is the part we spend most of our time on. What exactly does that mean, and how do you get there? Is it allowed to be done? One of the big questions we run into is around identity, and have you been KYC'd? Are you in a product that requires KYC? Jeff, I know you've thought about a lot of these issues sort of before jumping into Quadrata. What are the issues around KYC, when it's needed, and how you might solve for it on a DeFi?
Sure. Look, I think the starting point of that conversation is a question of what exactly is DeFi? And I don't think we need to go through the loop again, because I think there's a lot of people who have different views of it. But I will say, as general counsel, I formerly was the general counsel and on the founding team of Vertex Protocol, which is a decentralized exchange that has both spot and perps on it. We spent a lot of time talking about what is DeFi as well. And in addition to talking about it, we observed what was going on around the world. And what we've seen in the past 12 months or 18 months is that you have organizations like IOSCO, which is the International Organization of Securities Commissioners. Is that right? I'm glad I have somebody from DC sitting next to me. We saw FATA speak to it. And both of those organizations, which I think are kind of the thought leaders in how developments in regulation start to happen, are both questioning why there's if there is such a thing as DeFi at all. And they're specifically saying things like they're observing that none of these products don't have human beings behind them. They all are controlled by human beings. And I'm certainly not advocating that position, but I do believe, as a former securities lawyer in the hedge fund space, as the regulations developed around the hedge fund space 20 years ago, that it is the shape of things to come. And I think what we're going to see is more and more pressure put on organizations that are holding themselves out as decentralized. And, a prime example is what we saw last year with the UkiDAO case by the CFTC. They made some very provocative statements about how they believe a DAO is a person under the Commodity Exchange Act. And a lot of people can disagree with that. But as someone who spent, the better part of 20 years in knife fights with the SEC, I can tell you those are very difficult arguments to win. I think that there's a number of participants in our space that are doing a great job of pushing back on overregulation. But, most of the people in this room are coming out of, startup organizations that are very thinly financed, that are always looking for their next capital raise. Those types of scenarios make it very difficult to fight with regulators.
And we'll sharpen our knives for the regulator piece of the discussion towards the end. We're not going to go away from that. I want to go back to Ed quickly on the idea, though, that something is decentralized. What do we mean by that? We know there's a group of programmers. We know there's financing. You can go and meet with your favorite protocol, but the immutable aspect of what's out there, or the fact that a program is deployed and exists. Help us think through that.
Yeah. So let me explain why that's important.
Yeah.
Right. If you're in sort of the traditional tech world, if you're dealing with some counterparty, you maybe the code that implements, the computer code that implements some market is on their computing infrastructure, and you can't be sure exactly what's happening there, right? What's different about the blockchain space is the actual code that implements it is there, and you can do diligence, or experts can do diligence for you, and then you can really know what's happening. As an implementer, this means that I cannot hide from my users what it is that my code does. And they can diligence it to a degree that they could not if we were in a more traditional computing environment, because it has to be all out there. And they know that the code that I said I'm running is the code that's actually deployed. And all of that operates. Now, in addition to questions about, what is the mechanism, there's also questions about who controls it. And that's the aspect where decentralization really comes in. And it's really about who has the power to change the rules.
I think you started with transparency.
Yep.
And transparency is no option there. You've got to be transparent. It's public code. And then who controls it? It's really a consensus governance question that we're seeing a lot of models emerge and we're wrestling with. And then to me, the most interesting part or fascinating part is who can use it. And for the most part, the decentralized person would say anyone can use it. And maybe Anna, in the context of what you're building, but how do you think about that? Anyone can use what you're building, and in fact, you can't turn it off.
more, it's becoming more nuanced. So yes, you do have this, there's maybe you could call it kind of the ideological side or the philosophical side of DeFi where, you hew very closely to these, permissionlessness and so on. I do think we are starting to see more permission things emerge. For us, we're institutional type people. We want to bring institutions into DeFi if they prefer to trade and transact on, KYC permissioned types of settings, then maybe we're just very pragmatic, but we're kind of okay with that. I think protocols increasingly, you just have to kind of pick your battles. What type of protocol are you? What do you care about the most? What kind of users do you want to appeal to? And build accordingly.
And our audience is very institutional here, particularly at the SALT conference. And so we could build a completely different panel and get different versions of answers to these questions, which is it has to be accessible by anyone without barrier. And I mean, how do we navigate as an industry then to figuring out these questions? Maybe Ed.
I think there can be different solutions for different use cases. To me, the important thing is that there's transparency about what the rules are. People know what the rules are. They know how the rules are made in a particular system or protocol, and they know who has the power to change it. And one thing that certainly in the Arbitrum community that we've had to think about is as there's a proliferation of different chains that use this technology for different use cases, you do see that diversity of different approaches.
Yeah.
And different positions based on use cases, based on philosophy. And as a technology developer, we feel responsibility on certain issues like security, but we don't feel it's our job to micromanage what our users do.
Got it.
Well, this is one of the coolest things about building on blockchains, right? I mean, all these different Lego pieces that you can use to build your infrastructure that is suitable to your particular application.
You're making so many choices when you are deploying something. I keep going back to that word deploy, around security, around access, around the level of governance. And maybe Rashawn, to go back to DYDX, how are those decisions made to the extent you can come to them? I know, for example, not every human on Earth can access DYDX. So how do you, as a group, how do you think through those questions?
Yeah, I think trying to build within the DeFi space right now is considering many different types of risk and how much you want to take on, right? There's technology risk, there's market risk, there's also regulatory risk. So I think specifically in the case of DYDX, because of the product we offer, perpetuals, right? There isn't a regulatory pathway to offering that to American traders right now, right? So what we do, there are two classes, basically.
Well, there's a regulatory path, but it involves registering with a regulator and registering all your users. Yes.
Exactly.
Yeah.
Which is difficult to do for a DeFi protocol, right? That aims to be permissionless. And so there are these two groups. There's the United States, Canada, who we block out.
Okay.
And then there's also the sort of OFAC countries, right? That we want to prevent for reasons of money laundering, illicit finance.
Jurisdictions that have been identified as sanctions jurisdictions. And that's a good governance choice made because you don't want to aid and abet sanctions violations.
Yeah, exactly.
Always a good choice.
If we think it's kind of tough operating now in the United States, we have a different case.
Yeah, please.
And so, to give you a real life example, we are fairly agnostic about how people use our product. So as I said before, we mint an NFT into a wallet, we integrate with the dApp, and then the dApp queries the wallet directly on chain to get an answer to a question. Is this person on sanctions, or say on the sanctions list, for example? But the types of customers that we have, they range from DEXs to, we have a regulated insurance marketplace in Bermuda. We have gaming apps that use us solely for Sybil resistance to make sure that the bots are kept out. We have RWA providers that use us solely for accredited investor determinations because they're issuing security tokens in the United States. We have some that use us just for wallet screening, that being said, we have views. We don't give legal advice. But as everybody on the panel pointed out, I think how I would characterize it is that DeFi is at a stage right now where these decisions are being carefully considered. And I think, the one that, when I was on the founding team of a DEX, that I spent a lot of time considering is if we don't ensure that we're blocking out sanctioned persons, there's a certain level of risk you're just choosing to live with.
As our counsel often says, you just pick a level of risk willing to go with, and
it's
hope for the best.
But as Anna pointed out, everybody who's building in this space is observing that the pendulum is swinging in a direction that may be inconsistent with the founding principles of DeFi.
And maybe to risk going to policy, but sort of teeing up what we care about and are trying to solve for with all these choices. You want open access, robust markets. That's the open accessibility principles. You juxtapose that against deterring financial crimes, preventing financial crimes. There's choices to be made there. I think and financial crimes can be the money laundering bucket, the sanctions bucket, or the trade conduct bucket, manipulation, wash trading, those sort of things. I guess, Anna, as you're working on what is a type of decentralized exchange, how do the trade conduct considerations come into play?
I mean, that's the heart of everything we're doing. We're trying to eliminate a class of predatory behavior from the marketplace, not by trying to tack things on to old structures, but innovating the structure itself.
And I take a step back. When I think of regulation, we regulate, at least for many of my clients, we deal with the regulation of financial services.
Right.
We don't deal with the regulation of technology usually. And so then we're faced with a new piece of technology and we say, is this a financial service or is it something else? And maybe talking about your project or generically, what is a financial service versus a technology? That's a big question. I don't have to.
That's a great question. It's, I think we regard ourselves as a service, right? We're building an exchange. We know what it is.
Okay.
The mechanism underlying it is different, but just like a order book is a mechanism, you have over-the-counter markets, you have AMMs, you have these different mechanisms, but they're all a means that facilitate transactions between parties, right? So I don't think from what we're building, and we've built an enormous amount of infrastructure in order to deploy, this idea, but I don't think we're trying to skirt around, being unregulated because we think it's a technology, not a financial service.
Sure.
All we really want is some clarity. So the most important, I won't say I don't care what regime we have, but any kind of clarity was so helpful because clarity, it's just good for business. It makes it easier to make decisions. I think Jenny Johnson from Franklin Templeton was up here yesterday. She said she likes prescriptive regulatory regimes because they give you a list of things you have to do to comply. That such a list is very handy.
I mean, the list of things to do is always helpful if we allow a principles-based approach to complying with the list of things. I think we've gotten stuck, at least in the U.S., on this particular set of businesses of getting exactly right the list of things. Yeah. And so we've not done anything, and we don't have any disclosure. We don't encourage voluntary disclosure of information. And I'll jump off that soapbox. Ed, you're providing, Arbitrum, the blockchain layer. How do you think about your obligations from a policy and regulatory perspective when the tools are being built on what you've made, but you're not building the tools?
Right. I mean, we're building technology, and we're aware of how that technology is used by people and what models they have. And we feel a real responsibility to the people, especially to the end users, who ultimately are affected by the decisions that we make. And to build a system that's actually going to serve their interests and will tend to create fair marketplaces for them. And that means that we take care in the design of our protocol. So for example, our protocol we work hard to ensure the protocol doesn't have a role that would allow someone to front run users' trades without consequences or without that being evident.
Or that it's transparent if they're going to do that.
Or that it's transparent if they're doing it, right. We also think really hard about security because failures of security in what we do can undermine the whole thing, right? Any guarantee, any expectations that users have that their funds will still be there tomorrow, all of that depends on the security of the technical infrastructure, right? And so that is the paramount consideration.
Got it. And I want to come back to Jeff. I think another big policy issue is, can we just keep the bad people out? And if we can, then we'll have a little bit more openness to principles-based regulation on the other side. the way we keep the bad people out in traditional finance is we get your driver's license. And that's what's definitely worked. No bank has ever gone wrong by doing that. So given that you can't collect blockchain driver's licenses yet, is it possible to do this a new way? And I know Quadrata has its product, but maybe even more generally, is it possible to solve for keeping the bad people out without collecting driver's licenses, to say it very bluntly?
I think the answer is no. If you don't actually get proof of ID or proof of or liveness verification is what we call it. I think it's very difficult to keep people out. But I mean, I always think that in these kinds of conversations, real world examples is a good thing to share. And for those of you who think that this is an existential thing for DeFi, I can tell you in the past week we've onboarded 10,000 wallets and we blocked 30. So to me, as a former GC of a DApp, to kick 30 people out who potentially are sanctioned or doing bad stuff and keeping 9,970 isn't that big of a trade-off. And these were just random wallets that came in from around the world. So and by the way, the other thing I would also point out is that it kind of debunks the perspective of the haters who say that this is nothing but a thieves' den or the new Barbary Coast. Because if 9,970 are getting in and 30 are getting kicked out, it's really not a big deal.
Yeah, I think that's an important observation, which is when you do the KYC and in a way that works for the different projects, most of the overwhelming majority of the users get through, and that's what you would expect to happen.
Yeah, and if you wouldn't mind, the other thing I would tell you, so the way that our product works is we keep all of your PII off-chain. It's held with individual vendors that have their own security protocols. We are fully GDPR compliant, so if you're a regulated entity, you sign a contract with us, you get permission from your users, and through API calls, we can send all the PII, and the users actually have to check a box. Yes, you can get the driver's license. Yes, you can get my first name. Yes, you can get my second name or my last name. Yes, you can get my address. And if they don't check those boxes, the answer is no.
I think it's a great example of all the tools being built to solve for the two parallel goals, which is our principles-based regulatory considerations, but allowing the efficiency and value gains to come from decentralized environments.
Yeah, and the last thing, I don't want to turn this into a commercial for Quadrata, but the last thing I would say is we're single sign-on as well. So we have 25 dApps in our network. You go into one, you get into all 25, assuming that your money laundering risk score satisfies each of those 25 dApps. And my observation has been they all basically have the same level of tolerance. So if you're in one, you're into 25.
So we'll keep going down the policy. Did you want to say something?
I just wanted to say, if only all DeFi user experience was that easy.
Yeah, let's do user.
We spent a lot of time sorting through it.
Why does it suck so bad? I'm not sure. Why does DeFi so hard to use?
Try to onboard someone, and
No, I am.
5 minutes later, you will see the look and fear and confusion in their eyes.
Right.
It's hard. A lot of people are trying to solve this. This isn't a unique observation.
Yeah, there are many causes of this, and we need to solve them all before the user experience gets better, right? Some of it is just a lot of the people developing in this space just don't care that much about user experience. That's sort of not how they roll. Some of it are problems that kind of bubble up from the lower infrastructure levels. The fact that it takes a long time to get finality on a transaction on some chains, for example, that really can bite the user experience.
Was a security trade-off.
There's a security trade-off, yeah, that the system developer wants to tell the user that their transaction has happened, but the underlying technology hasn't decided that yet. So the user experience is going to be bad one way or the other. Either you're going to tell the user it's done and then you might need to come back later and say, no, actually it wasn't, or you're going to make them sit around for a long time. So some of it bubbles up from like lower tech infrastructure, right? And some of it frankly comes from being overly rigid about sort of decentralization ideology, right? That everyone has to manage all of their own keys always, and you have to self-custody everything, right? Everything has to be DIY. And I think, and that can't be the long-run solution.
Dangerously close to suggesting that we need some intermediaries to come fix all of this for us.
Choice. Intermediaries
by choice, sure.
Intermediaries by choice, and a choice among them.
Yeah.
Yeah. Well, a good analogy of that just in the normal world is we have most of the people on our team are like Mac and Linux users or one or the other. You know, you can have the full DIY experience if you wish, but for the rest of us, you can just open up the MacBook.
And it's important that you can have a babysitter, but also it's important that you get to choose your babysitter.
Yeah.
Sure. So let's jump deep dive now into the policy. I think we could get alignment from the entire room that a nice principles-based articulation of what we care about from the government would be great. And then if the government said, comply with those principles and be prepared to tell us how you do so, like we could all live with that. So in that context, Rashawn, I know you were on the Hill for a while. Who should win the election and why?
Well, I'm definitely not going to go too deep.
Good. Yeah.
Question, but I think engaging in the policy conversation today in Washington, D.C. and other places around the world, particularly in D.C., is interesting because we're talking about, in this conversation, this spectrum of decentralization and this idea of when or where intermediaries are useful. But we live in an environment with a regulatory system completely predicated upon the existence of intermediaries. Those are what's regulated and obviously the activities that they take on, right? And so there's a few different pieces when I'm having conversations with policymakers to try and build from a ground level and gain some, balance in our conversation. I think first is that DeFi is different. I think there are some things that DeFi enables and some activities and actions that are similar to ones from the traditional financial world. But from a technological standpoint, we're doing something different kinds of risks. It doesn't get rid of risk, right? But the different types of risks are fundamentally different. I think second is that DeFi should flourish here in the United States. That's
a policy decision someone has to make.
Exactly.
Yeah, that's right.
And so that's been a real piece of contention over the last couple of years with prominent members of Congress and others saying that, there is no space for this in the United States. Obviously, we've been great leaders in finance, in technology. In this next wave, we should also want to lead. The third piece is that the time to do this is now. I think the United States is the indispensable player in this global regulatory system, but there's probably a window of time we need to act within. And we're probably getting pretty close to the end of that window now. I think, if we come up with a comprehensive regulatory framework that, is, permissible and gives us things to share with the government, then I think the United States is probably still poised to be the best place to build a business for a long time.
Maybe to anyone. I mean, is the United States needed for the decentralized finance world to grow? Like, do we still have the chip that is, we're the biggest, we have the most financial resources, we have to be there, or is there a risk that it's just ignored?
I would say, I think the biggest problem that's caused by the U.S. dysfunction is the psychological impact it has.
Okay, yeah.
People are afraid to be in the States. I personally wrote the disclosure on the Vertex website that said, you may not enter if you're from Cuba or Iran, Syria, North Korea, and the United States of America. It's ridiculous. And I understand the complications around it, but I think the psychological impact really kills people.
Yeah.
I mean, at this point, we are more likely to launch in France before we launch in the United States.
Right.
And I mean, just think about that. That's bonkers.
It's potentially a huge lost opportunity for the U.S. I think we can learn something actually from the regulatory history of cryptography, right? Back in the 70s, 80s, and 90s, access to cryptography was tightly controlled, and the government policy was that U.S. companies could not make or certainly export products with strong cryptography. And there was a real sense that the U.S. was going to lose the lead, not only in cryptography, but also in Web 2 or Web 1, because that relied fundamentally on encrypted communications. And what happened is in the 1990s, the Clinton administration made a really important decision that, no, we're going to open this up. We're going to allow U.S. companies to build and export strong cryptography. And that's really what has allowed that sector to develop in the U.S. and to be the world leader. And I think we're at a moment like that for this technology now. But, my worry is that our policymakers won't recognize it.
Yeah, well, thank you to everyone. We covered a lot of ground. Thanks for listening, and we'll see you again.